Hey guys, it's Justin Goodbread here with Financially Simple. It is Friday at 4:30 on a long weekend. I hope you have some plans ahead for this weekend. Man, I know I'm going to run a chainsaw a lot this weekend. I'm going to be goofing off and doing some work. I'm hoping to get the boat out on the lake one more time this weekend, but man, I'm ready for it. So it is Friday. My brain is fried, but we have a ton of questions this week. Our lines have been lit up. We have all sorts of questions from various folks. We have some questions that we're going to answer from last week's Stump Justin episode. Sorry, my nose is itching. We had some questions come in on Twitter. We had some questions come in through Investopedia. As you may know, I write for Investopedia. I write for Forbes. I write for Kiplinger. So I get questions from those directly to me. A lot of those folks join us on this video during the week. And so we're excited to answer a lot of questions this week. And I have a ton here. So if those of you who are joining us and those of you who are going to watch this video later on, feel free to shoot me a message, shoot me a comment here on this particular video if you're watching it later on. If you want to leave me an email at info@financiallysimple.com or justin@financiallysimple.com. If you want to shoot me an email at one of those locations, well, our team will get it. They'll put it into the queue here of all these questions that I get to answer for this particular week's episode. So today I'm going to go through and start answering a lot of these questions here today. And so there's some fun ones in here. I'm going to start off with this one. I thought it was intriguing to me. And the question is this. It says, so Justin, because of my low income, would I not be subjected to capital gains tax if I sell my house? Let me ask that a different way because I didn't like the way that question was worded. They're basically saying, if I sell my house, am I going to pay taxes on the house? And then they went on to say, Justin, I have a house in California worth $2 million. I have been in the home for more than 30 years. The original cost was $70,000. Man, talking about a nice investment. He said, I spent about $50,000 in repairs and upgrade. My total income between Social Security and a little bit of income from my pension is about $30,000, and I have no other income or investments. Because of my low income, would I not fall into the 0% capital gains tax? So that's what he's asking. Is there a way to determine this? So here's the quick answer for that. As individuals, we can buy properties, which is what a lot of us do. We buy houses, and we can allow those houses to appreciate in value. But the IRS says that we can sell for a married couple, a married individual, married couple. We can sell a house, and the first $500,000 of those gains, in most cases, are not taxable. Anything over the $500,000 is going to be taxable to us as capital gains tax. So in this particular case, I told the individual, I said, you need to talk with your tax advisor. And they said, yeah, we've reached out to this individual. We've reached out to our tax advisor. And he said the exact same thing you're saying. He's saying, Justin, that if I sell my house for $2 million and my basis, which is the amount of purchase plus his repairs and maintenance in the house, is roughly $120,000. If my base is 120, but it's currently worth $2 million, and if I sell it for $2 million, I'm going to pay taxes on that gains for most cases. Now, there's always an exception to the rule in finance, but a majority of times you're going to pay taxes on that. So for those of us who aren't dealing with a $2 million house that's appreciated in value that much, if we have a house and it does appreciate and we want to sell it, as long as we lived in that house for two of the last 5 years is the rules, then the gains, in many cases, the gains are not taxable as long as married couples don't exceed $500,000 in gains and single individuals don't exceed $250,000 in gains. So by no means is anything on this show considered personal financial advice. This is just educational purposes only. I'm going to tell you that this is where you talk to your tax advisor. In this particular case. So talk to your tax advisor, see what they have to say about your particular circumstances. The information that this individual gave me is not enough for me to actually give advice. But I'm going to tell you the same thing I told this individual, talk to a tax advisor. So I thought that was an interesting question this week. Hey, for those of you coming into the show right now, if you have a question, just drop it in the comments section and I'll jump on it today. The idea is to try to stump me. Now, I got a lot of questions here this week that are kind of tough. I'm not sure I'm going to stump me, but they're kind of tough. Here's one that's an interesting one here. It says, The title of it says, what are some strategies to minimize the impact of taxes for high earners in a high tax state? And they said, my wife and I make about $900,000 combined. We live in California. We pay a lot of taxes. Most of our income comes from our salaries and bonuses. We like to minimize the impacts of taxes. What might be some good choices for us to consider? Should we use taxes? He says taxes at bonds don't work, and tax loss harvesting are minimal, and they very little impact to our net income. Is real estate a good idea? What other ideas should we consider? So that is a very big question. The ultimate question is look, we make a lot of money. How do I not pay taxes on it? How do we reduce our taxes? Oh, you know what? I just finished up a conversation with one of my clients and his tax advisor, who I work very closely with. And we were having this discussion on almost the exact same numbers. I mean, I just hung up the phone probably 15 minutes ago. We were diving deep into some various scenarios, and we had ideas that were created like conservation easement. We dealt with defined benefit plans. We dealt with charitable remainder trust or charitable lead trust or charitable annuity trust or all these type of charitable trusts. We talked about gifting. We talked about charitable annuities. We talked about a lot of different things. Here's the thing. Whenever you're dealing with high income, there's never just one thing that you can do to minimize your taxes. Very seldom is that the case. So you start with the basics. Are you maxing out your retirement accounts? That's number one. Most people aren't. They're looking for the quick bullet. So number one, are you maxing out your retirement accounts? Are you using an HSA or an HRA or an HFA, any of these type of health accounts? Are you using these accounts? HSA, HRA are some of the best out there for people who are high income earners. After you get out of the basics, then you go into, well, can I use real estate? Real estate works decent. The new code allows us to take a lot of upfront accelerated cost segregation studies on residential real estate with the new way the new tax code works. So it can help in 1 year, but it may not help the next year. And if you go to sell the real estate, now you're left doing a 1031 exchange or either paying recapture tax. So I'm going to answer the question as this. The question was, is there one thing I can do to help minimize my taxes? The answer is no, there's not. There's a multiple of things you can do, but this is where you're going to have to get with, like our clients just did, get with the planner, the CPA, and a tax attorney. Get all three of those parties on the phone. That's what I just got done with. When every one of those professionals on the phone have different ways of thinking, I put out ideas. Some of them were good, some of them were bad. The attorney put out ideas. Some of them were good, some of them were bad. And the CPA put out ideas. Some were good and some were bad. But what happened is that brain trust came together and we had multiple different scenarios. Now my job is to come back with those other parties, with the attorney and the CPA, and to figure out which one or which path is going to yield the results that this particular client needs. That's the same approach that this individual needs to take. If you're making a ton of money, this guy said they're making $900,000 combined. If you're making that much money, you're not going to get the answer to your question in a one line. You're going to have to spend some time, get with some professionals, and let them use their minds, their power, use programming to figure out which concepts, plural, can help you minimize your taxes. So there's not just one idea. There's multiple different things. So those of you who are just joining us, what I'm doing is I'm going through and answering questions from individuals that we've received this week. If you're watching this later on and you have a question, you can reach out to us at Justin at Financially Simple. You can leave us a question like this next individual did on Facebook. They actually sent a message. You may go on Twitter and shoot us a tweet out there and say, hey, Stump Justin, hashtag Stump Justin. Here's a question for you. This question comes in and it's from one of our listeners. And the question was, self-directed IRA with interest. So they have a self-directed IRA and they're using a company that they're as the custodian. They rolled 401k money into an IRA account, which is common. A lot of times whenever you leave your place of business, you have a 401k, a 403b, or some sort of retirement account, and you're retiring or you're moving from one job to the next, you will roll over. You'll move the monies from that corporate retirement plan into an IRA or to a self-directed IRA. That's a very common practice. And there's many reasons why you would do that. The one reason why I personally did it with my own money, whenever I changed some things in our company, was it allowed me to open up my investment world to more investments than I can often in a 401k. Now, there's reasons why you would not do that. 401ks you can borrow money from, IRAs you can't, for the most part. Again, there's always exceptions. But the question goes on, it says, I roll the money from a 401k to an IRA account, and I purchase real estate. So, and they said, what is the best way to get out of an IRA with the lowest amount of tax ramifications? All right, so we got to dissect this particular onion, pull back the layers, okay? So the money was moved from a 401k to an IRA. We got that. That makes sense to us. Then they bought real estate with the monies. Now, you can use IRAs, Roth IRAs to purchase real estate. Many people did that some years back. I'm going to tell you, I am not a big fan of that. I'm just not. There's a number of reasons for that. Let me give you a couple of the highest levels. Number one, the reason why most of us purchase real estate is because of the tax benefits. Whenever you buy it in an IRA, you're basically forgiving, you're not getting those tax benefits. And in fact, whenever you pull the money out, you're paying taxes at the highest bracket. So whenever I purchased my rental property some years back, and I'm selling my last one next week, whenever I purchased rental property, I did it outside of my IRA. And so I received tax deductions through the years. My income dropped drastically through the years. A lot of different things transpired. I turned the phone off. A lot of different things transpired through the years that allowed me to reduce my taxes. Now, when I go to sell my property next week, my CPA, my tax advisor, and myself have already ran the numbers, and I know that the majority of my earnings are going to be taxed at a 15% bracket, at the lowest capital gains bracket. Now, I'm going to have some recapture. It's called recapture tax from the depreciated asset. But in an IRA, you lose that. You lose the ability for tax benefits if you use your IRA for real estate. So that's number one. The number two reason for IRAs is you're required to take distribution out of your IRAs at a certain age, 70 and a half. It is near about impossible to get money out of a piece of real estate to meet the required minimum distributions. It's very impossible. I'm not saying it's not possible. It's very difficult. So that's another reason why I don't like using IRAs to buy real estate. I know you can. Again, you can. I just don't like it. The third thing about IRAs and real estate is it prevents me from being able to leverage dollars. Real estate works really good for what's called a cash-on-cash return. If I can put 20% down and get appreciation on that 20% in the markets, then it helps me out drastically build my net worth. If I'm using my own money to go out and buy a piece of real estate, I lose the ability to leverage my assets. So I'm just not a big fan of using IRA money to purchase real estate. So let me address that, number one. Then the question goes, I want to know the best way to get out of an IRA with the lowest amount of tax ramifications. Okay, so my simple answer to that is time. If you can spend down the IRA slowly over time, then you can get out of the IRA with the least amount of tax ramification. Anytime we take money out of an individual retirement account, I want to say anytime, most of the time we take money out of the individual retirement account, we're going to pay taxes. We're going to pay taxes at an ordinary income rate. If we dump up a lot of it out at one time, like we talked about last week in our Ask Justin questions, then we're going to increase our taxes and it ends up hurting us. So what's the best way? I don't know. I don't know the particular circumstances here in this particular situation. My answer to you is get with a financial planner, get with a tax advisor, let them see what has transpired. Make sure that you haven't hurt your IRA. If you didn't follow the rules just right, then you may have already blown up the IRA. You may already be a taxable event altogether. What's the best way to get out of an IRA without the lowest tax ramifications? Man, it's going to be building a comprehensive plan and use time to your advantage. You could use some charitable contributions to offset it, but outside of that, it's just going to be time. But there's some other tricks of the trade that you could use, but you need to get with a planner or your tax advisor to ask that question. With this particular thing, I can't tell you the best way on how to get out of an IRA with the least amount of tax ramifications. I don't know enough about your particular mix, but I can tell you that I'm not a fan of using IRA money for real estate purchasing. So I hope I answered that question. I'm going to tell you, go back and talk to your advisors, and they can get you the specifics. If you don't have an advisor, reach out to a good certified financial planner and a good certified public accountant, and they can help you with that. All right, so we have a lot of people jumping in right now onto the live video. So here's what I'm going to tell you. If you have a question for me, now's the time. Drop a question in the comment section here below. If we don't get to it on the show today, I've got a list of questions here that I'm working through today, man, that came in from this last week. A lot of people are sending emails to justin@financiallysimple.com. Even on our podcast, I had a question come in from a listener on our podcast. So we have a podcast, Financially Simple, is on iTunes, Stitcher, Spotify. Someone was listening to something and they reached out and said, Justin, I got a question for you. So if you're listening to us on the podcast, on YouTube, on Facebook, on Twitter, Instagram, wherever, if you have a question, put in the heading Stump Justin, and I'll put it to the list, and we'll deal with it next week in our episode. So another question we had come in this week is, it said, what should I do with the extra income I'll be earning from a promotion? It said, Justin, I'm 26 years old, I'm married, and I have 3 kids. I've been there. I was recently promoted. Congratulations. I'll now have an extra $300 to $400 in income per month. What should I do with it? I have about 3 months of savings in an emergency fund. In quotations, he said, I knew you were going to ask that. And it said, should I invest the extra income? Should I put it in a savings account, or should I pay off a little bit of debt? I'm new to investing. I'm not sure what to do with a little extra income. So that's all good questions. So let's peel this onion back slowly, okay? Congratulations, number one, on your emergency fund. Props, mad props, 3 months worth of expenses. You don't say if your spouse works in this particular case. I reached out and I found out their spouse does work. So they do actually bring in income. So I'm going to say that 3 months worth of cash is probably good for this family. Now, you say that your next question says, should I put the extra income into a savings account? My question is do you have the ability at work to contribute to a 401k or some sort of retirement plan? If the answer is yes, then I'm going to tell you, if you're eligible for enrollment in that plan, go ahead and enroll in the plan and put the extra money, this extra money, out of sight. I use an acronym called MOOSE, like the big thing with horns on its head. The MOOSE stands for monthly, the M, out, the O, of, the other O, sight, the S, expense. So monthly out of sight expense. MOOSE. If you can put the money back out of sight every month in a habitual way and invest it, not a savings account. We don't need any more cash based on the data that you provided. But if you can put it back now and just leave it alone, get a good high quality stock investment, something like a mutual fund or an exchange traded fund through a 401k, and just leave it alone, that extra money is not going to create taxes in most cases, because we're going to be able to offset it with our 401k pre-tax contribution. And it's going to create a compounding growth factor for you. So I don't want to see this extra money going toward any cash accounts. We're too cash rich in some cases. I want to see the money starting to work for you. Now, you said you had debt. When our conversation, this individual said, my debt is on my house. I'm like, you don't have any car debt. You don't have any credit card debt. We don't have any student loan debt. So this is a pretty good little position for this 26-year-old young family. Now's the time for them to start taking this $300 to $400 a month and start putting it back into a savings account. Now, if you're not eligible for a 401k, you can obviously look at an IRA or a Roth IRA. Either one of those, depending on the income brackets, will make a lot of sense. I love the Roth IRA. In fact, me and Miss Emily just maxed out our Roth IRA for this year. I'm super stoked about that. I like the Roth IRA. I personally use that. So if you don't have a 401k at work, you can use a Roth IRA and get tax-free compounded growth on that money. So if you got a little extra income in this particular case, put that extra income toward an investment. We don't need to save more cash. Now's the time to start investing and allow the power of compound interest to just move your net worth into the future. Good question, though. So here's another question I got this week. Just a quick tweet. Hey, Justin, hashtag Stump Justin came in on Twitter. What should I do with an inheritance? Okay, simple question, but I understand Twitter. So I recently, my aunt, someone who I love, this lady was at my life every Christmas, as long as I can remember, just a crazy aunt. She left me and my brother and my sister a little bit of inheritance. I'm having to deal with the same question. My family, my brother, my sister, are dealing with the same question. I can tell you what my thinking on inheritance is and how to utilize that. So what should I do with an inheritance? Number one, look at any debt that you have that's stupid debt. Stupid debt, I use stupid debt. I don't mean that in a derogatory manner. Student loans, credit cards, car loan. Any of those things, why don't we use some, maybe not all of it, but some of the inheritance to pay off some of that crazy debt? That's number one. You say, Justin, I don't have debt, or the inheritance is larger than all my debt. Then number two, you got to spend some money. Time out, Justin. You just told me to spend money. Yeah. Our families gave us this money for us to enjoy. So in our case, I went out and bought me some new things for hunting. I'm enjoying the fire out of them. Miss Emily went out and bought us, she's been wanting a new couch and some chairs, living room furniture. She bought us some living room furniture off some of the inheritance, something we've been saving some cash toward. I think that my aunt would be pleased to know that we were able to use some of that money for our own benefit. We were playing with the money, but we also invested some money. So that's, we used some of that money to finish maxing out our Roth IRAs. We finished maxing out our HSAs. We finished maxing out, or we will finish maxing out our 401ks. We're investing some of those dollars. So I can tell you that number one, you pay off your crazy debt, your stupid debt first. Credit cards, student loans, car debt, pay those off first. Then spend a little bit of money on something that you've been wanting. That's that way your loved one, they gave you that for you to enjoy. Okay. And now whenever I see those things that we bought, I'm sitting here looking at my aunt and just enamored that she loved us so much that she would give us something. That's where inheritance comes in. And then the third thing we did is we actually invested in. So now as we watch those investments grow, my aunt has positioned my family, my brother, my sister in a position to where we're going to be a little bit better off because of her generosity and her love for us. So if you're getting an inheritance, go with that. Go number one, pay off some debt, pay off the crazy debt first, spend a little bit of money, enjoy it. Do some things that add value to your life, that you can create some warm fuzzies for yourself, and then invest a little bit of that money. So that's what you should do if you have if you get an inheritance. Thought that was a cool question. Now I've got a lot of questions here, but perhaps the number one question that I need to answer is, I'm trying to get the microphone up here so you can hear me on this one. I have gotten lots of text messages from friends, lots of messagings from Facebook, things from Twitter, just all over the place. So I'm sitting here in the office this week, and for those of you who subscribe to the Financially Simple channel, I did a quick impromptu video on buying a car. Holy cow, it is driving me batty on what I got to deal with. So let me lay out the story for you, and I'm going to tell you kind of where I'm at today. And I'm going to promise you it's going to change. So I have stumped myself. I'm stumped. Justin has stumped himself. Here's where I'm at. I need to buy a car. What do? Do I buy a used car? Do I buy a new car? Well, my initial thought is buy a used car, buy a used car. I've been preaching it forever, buy a used car. Except I'm working on the numbers. So I've looked out there in the car space, and I've looked at the vehicle range that I want to buy. And between a used car with about 30,000 miles on it and a new car, there's only about a $5,000 difference. It's not a lot. Now, I did the same exercise about 4 years ago, and there's about a $15,000 difference between a used car and a new car. Right now, there's only about a $5,000 difference. So I've looked at every make. I've looked at Toyotas and Chevys and Fords and Hondas and Nissans. I've even looked at some luxury vehicles like Infinitis and Acuras and Lexus. I've looked at a lot of different vehicles just in my nighttime playing with my phone. And there's only about a $5,000 difference. So I'm calculating, and I ran this calculation on my Nissan Murano. I bought it. And over the last 4 years, I have put 120,000 miles on it in 4 years. That tells you the amount of driving I do. In those 4 years, I have spent, but from the purchase, and I got a good deal on the car. From the purchase, the repairs, the maintenance to today, I spent about $22,000. So I'm spending roughly about $400 to $500 a month on this vehicle, okay? And I've only got 4 years out of it, and the car is like, it's done. I wish I could go further, but it's done. Now, I spent about 20 grand, but I can get about $5,000 when I sell it. So I'm net about $15,000 over a 4-year period of time. So keep that in mind. That's my math on this side of it. So now I realize that if I buy a car with 30,000 miles on it, for me, that's about a year to 18 months worth of driving. If I calculate that I just spent $400 to $500 a month, in a year to 18 months, I'm about $6,000 to $7,000 to $8,000 that I would spend in that $30,000 range, in that first 30,000 miles. Therefore, for me to buy a new car and a used car, if I equate them and I get the mileage just right, they're equal. They're about the same price. So then I said, well, my goodness, a used car used to be the way to go. Now I'm looking at a new car and I'm going, man alive, I don't want to buy a new car. First of all, they're crazy expensive. I can't believe the price tags these vehicles have on them. But I pick up a warranty, and several of these companies like Toyota, like Ford, like Infiniti, like Honda, they have lifetime warranties on them, on the engine and the transmission and the chassis, the drivetrain, et cetera. And a couple of these things have even greater warranties based on the dealership. So I'm looking at a $4,000 or $5,000 difference, saying, man, I don't want to buy new, but I'm spending about the same amount of money when I equalize out the mileage, and I can get a warranty with lifetime on it as long as I own it. And I own cars typically for like 20 years. In fact, we have a Ford Excursion I bought. It's a 2002 Ford Excursion. I bought it in 2005. We're pushing about 300,000 miles on that beast, and we're going to get it to 500,000. That's what we're knocking on wood here. That's what I hope happens. So I've stumped myself. What am I going to do? I don't know. I'm going to go out of town and not think about it. That's what I'm going to do. And I'm going to see what the car market does in the next 30 to 40 days. And depending on what the car market does, I may buy new. And as much as I would used to fuss about that, the current pricing is so crazy where the new cars and used cars are very similar in pricing. Now, I'm forecasting out. I realize there's just over, I think the number is 70-something million cars that have been sold in the last 5 years. Every year has been a new all-time high on the sales price. So what's happened is the new cars have been flooding the market, and the used car quality is way up. So because the quality is way up, that's where the price comes in. Again, 5 years ago, it wasn't that way. 5 years ago, you could buy a 2 or 3 year old car and be giddy up good. If you have any insight on that, let me know. But I'm stumped myself on that for the time being. I don't know what I'm going to do right now. Hey, I'm going to answer a couple more questions here. If you have a question this week, drop me a line on the comments, or shoot me an email at Justin@FinanciallySimple. So here's one of the last two questions I'm going to deal with. Here we go. Question was, Justin, what is a safe return to assume when you're running retirement projections? And so I responded. I said, what type of retirement projection? I said, I'm just using a basic calculator. So I wrote back 7%. That's this number that I would use for this particular age individual. Now, you may be different. Your age may put you where you don't need to use 7, you need to use 5. You may not need to use 5. You may need to use 3. It just depends. But in this case, I told the individual 7%. Then they said, well, where did you get that from? And here's where I got it from. CalPER, C-A-L-P-E-R. That is the California Pension Employee Retirement System. So that is CalPER. CalPER, which is the largest pension plan in the United States, actually in the world, largest pension plan, says that their forward projecting assumption that they are using is 7%. So it's a reasonable return. You know, some people in the media world talk about this 10, 11, 12% long-term returns. And friend, that may happen. That may happen. Whenever I'm doing projections for myself, though, I like to plan for the worst, hope for the best. My clients hear me say it all the time. Plan for the worst, hope for the best. Let's identify every major obstacle out there. Let's plan for it, and let's hope it never happens, okay? My safe assumption return for this individual was 7%. Again, yours may be different. You may be at 3%, 4%, whatever, but it's interesting to me that the largest pension company who manages tons and tons of money is only calculated on 7%. Now, there's a lot of other studies out there that are actually smaller than that. There's some that I saw that were at 6% and 5% going forward. My own planning software in the office just this week updated to a 5.46% assumption in the U.S. stock market. Now, I don't know if that's the number. I don't know. It could be higher, it could be lower. But I thought it was interesting that CalPER said 7%. So what's the safe return to assume when running retirement projections? I have the tendency to say not higher than 7% right now, not given the current market conditions. We get one more question here, and we're going to be done for this week's edition. The question was, why does my advisor charge 1.5%, yet others charge 0%? What gives? Okay. That was a good question that I received through Twitter. Well, it's interesting that you say your advisor charges 1.5. I don't know how much money you have, but I would bet it's not a large amount, because the way the financial world works in the money management space is the more money you have, the lower the fee becomes. In our office, it's on our website, but I think until you get to $1 million, it's like 1.2, 1.1 or something like that is the advisory fee. But you made the statement that why is the other charge zero? Do they really charge zero? Are they in business for free, or are they in business for a profit is my question. Chances are they're not charging zero. Chances are they have another charge somewhere else that you haven't seen. And we took on a new client this about 2 months ago, and the gentleman had a fair amount of money, millions of dollars. Let's just put it that way. And he was comparing the cost of managing money with his current firm, he was unhappy with, and our firm. His current firm was charging him 1%. We were going to charge him 1%. So it was an apples to apples cost. But I had a small technology fee of like $50 on there. And that was his fees. But he said, Justin, over here, I'm only paying 1% on about $1 million, but on this other million, I'm not paying any money. What he had was actually a type of an annuity. And there was actually a fee, but it was hidden from the individual. And so I had to go in, I showed him, here's the actual cost of the product. The other thing that happened was he bought a product from this other advisor, and the product went bankrupt. And he actually ended up losing $200,000. Gone just that fast. He and I were talking about it, and I try not to pour salt on the wound, but I said, so-and-so, I understand that you think my fees are higher, but I haven't lost you $200,000. That's not even a chance to rebound. The bank company went bankrupt. And he said, yeah, I know. And I said, and I haven't placed you into a high-cost annuity that the other advisor made almost $90,000 on that you're stuck with now for 10 years. I haven't done that. And he goes, yeah, you're right. I said, but instead, I'm going to use you in very liquid, build a very, very diversified portfolio that's to your risk tolerance, and we're going to save you some money on the other areas. And we ended up showing him that we saved him a lot of money in some tax planning and some retirement planning projections or retirement planning that we're doing for him. So why does my advisor charge 1.5%? I bet, just knowing the math, I bet they're a registered investment advisor. I bet they're using full disclosure, and I bet the money that they're managing for you is quite small. Where does others charge 0%? There are others that charge 0%, but they're making their money somewhere else. I'll give you one last point to think on that. Fidelity, about 3 weeks, maybe 4 weeks ago, actually came out with their free mutual fund. Now think about this. How can you have a free mutual fund? How are they making the money? Well, that's through swaps. That's through peer lending. That's through a number of other things that are happening behind the scenes. So if everything is free, how long is the company going to be in place? Or are they making money elsewhere that could potentially harm you long term? So there's nothing in life is free. We know that. Nothing in life is free. So whenever you see an advisor that's charging something, chances are they're trying to get you the exact data, and they're not trying to hide stuff. Yet others charge 0%. No, they don't. They're making money. The question is, how are they making it, and are they being honest with you on how they're making the money? So, guys, that's a lot of questions. I am exhausted. I am ready to go home, just enjoy the weekend, run some chainsaws, get on the boat, have a nice long weekend on this holiday weekend. Look, that's a lot of questions we're going to be answering next week. Next week, I'm actually going to be driving. I'm going to pull off somewhere in Kentucky as I'm driving. I got to go out of town for just a couple of days. I'm going to pull out off the interstate. We're going to shoot an Ask Justin question next week somewhere in Kentucky. I'll be back in the weekend, but I think it's one night overturn. But if you have any questions, reach out. We'll answer them. Until then, guys, hey, check out the podcast. The podcast is rocking. The newsletter, oh my goodness, the number of people who have signed up for the newsletter is just beyond me. So if you're interested in that information, we've got a good rocking newsletter. Sign up for it at the Financially Simple blog. Like I say every week, life is hard. It is. Life is sad. Life is tough. And money can be frustrating, but it doesn't have to be. Let's just make our lives at least financially simple. Hey, y'all go out and have a blast every weekend.